Hey, Danny.
Hi, everyone. Just to let you know, you are automatically muted when you come in, just because we want to make sure we don't have a lot of feedback. Welcome. We'll get going here.
Hi, Randy.
Hi, Randy. We
Hey, Danny.
are going to start here in just a minute. We do have about 225 people that are getting on here today, so it's going to take a few minutes for everyone to be able to load. So we will give it just a couple minutes.
Gina.
Does everybody have their drinks? It's happy hour. Cheers. Cheers.
Cheers.
And I unfortunately only get to see some of you come up because the big screen only holds so many.
Here, we'll scooch over and see.
Hi, Serby.
Kirby, but she's not showing her picture. There's Gina.
Hey, Windus.
Windus. Do you have a glass of wine, Windus? Yay, cheers. We're on 3 pages now.
You can hit admit.
Huh?
Just go.
You want to go ahead and start?
Yes, please.
All right.
Hello to you all. You're still going to hear some people chiming in and out as we go along. Welcome to the program. Shelly, you're up. First off, I hope you all brought your glass of wine, or in my case, glass of tequila. We can thank Taz for overpouring my tequila snifter today.
Yes, and there's Ron. Hi, Ron. I recognize your face. All right, so I'm going to go ahead then and share our screen so we can share our slides and get us started. All right, y'all should be able to see my slides now. Yes?
Yes, please. That you can't hear them, so we're all good.
Okay.
Because we can see it here too.
Yes. All right. So this is the virtual series, virtual happy hour series. This is our second one in this series about navigating your business evolution. Last week we talked about the PPP loans as well, but this week it's more focused on the forgiveness side of things. So we'll get into that a little bit more here in just a second. Let me go ahead and let Melissa and Joe welcome everyone. This just so I can give you just a little bit of information here. This is a Exit Planning Institute, and 3 of the Southern California chapters, or all 3 I should say, have joined together to bring this event or this series of events to you. And so the 2 folks that you see on the screen there and then also on the call are Melissa and Joe, who are the presidents of those chapters.
So I'll introduce first our partner, Melissa Silverman, who is the chapter president of Los Angeles, the oldest chapter in our group. Melissa is a valuation expert, a trained attorney as well. She's also a partner in Founders Group. As many of you on the call, helps business owners or are business owners. She's a business owner herself, helping others as well. Melissa, want to say hi, everybody?
Hi, everyone. I apologize that you're not seeing me today, but I have what's known as a black eye, and you don't need to see it. So I'm going to just
Yeah, she's not sharing.
Yeah, I'm not sharing today, but welcome to our continuing virtual series for business owners and advisors as well. We wanted to be able to provide you with ongoing education as we're going through this virtual summary or I should say as we're going through this economic recovery. And since we can't provide live programming for you and educate you on exit planning, succession planning, we wanted to do something else. So that's why the 3 chapters have come together. Joe is the other president of how many chapters? 2 chapters? Only 2 chapters, Joe? So
I'm working on it.
I know. He's the president of the Orange County and the San Diego chapter. He's also an attorney with and co-founder of Srizeri Mancini, and they do tax planning, business succession planning, family governance, and a whole lot of other handling legal messes for families and for business owners. So Joe, why don't you take it away? And everybody, welcome to this ongoing series. We hope you will continue to come back and listen to the experts that we're bringing in to talk with you.
So first off, a big thank you to our presenters, which we won't roll to yet, Caroline, Jim, and Steve. Also, a very large thank you from Melissa, myself, and Shelley to the board members that represent each one of the chapters that put this series on. Thanks for doing that. Welcome to all the business owners. Some of the people on the call are actual business owners that are our clients and our friends' clients, and then some of the advisors that we work with as well. You'll continue to hear some click-ins as people register in a couple minutes later. We're going to give you a little bit of background on all four presenters, including myself being one of them. You should always, as a business owner advisor, be aware of the bias of the advisor that's speaking. To give you a little bit of my bias, we own the Southern California Institute. It's a thought leader organization that puts on 250 programs a year, live and digital, events, programs, think tanks, and introductions to advisors on legal, financial, tax, and counseling. Srizeri Mancini, the firm that started it all, my partner Steve and myself, 7 attorneys and 20 team members that help successful families and business owners. We're known for getting to the heart of highly relevant matters and resolving messes. We deal with integrated tax and estate, business succession, and family governance, or what you may call family business controversy work. And then my partner, Shelley Lightfoot next to me, and Melissa, that are on the phone, along with our other 2 partners on the Founders Group, where we help business owners that are faced with, do I keep and grow my business? Do I stabilize my business? Or do I transfer it to my family, transfer it to my team and executives, or transfer it to a sale in whole or in part? So my biases come from this kind of a background. I'm a lawyer by training, and I work with business owners this way. For our next presenter.
Let me just also mention, if you have questions, we are going to allow for questions between each of our sections. So there will be about 4 or 5 points throughout this presentation, and then a longer period of time at the end for question and answer. You can always type in a question in the chat function. Our experts will also be monitoring those chat questions, and so we'll try to answer those throughout the presentation. And sometimes we will bring up a question for everyone to hear as well. So we really want this to be as interactive as possible. So feel free to ask those questions, and we'll keep it rolling.
So there's going to be 3 major sections within this. In between those 3 major sections, we will ask for questions. And at the end, our goal is to have the presenters present for about a half an hour, and then have a half an hour to an hour afterwards, hence running to California time between around 5:30. If you need to be off by 5, we understand. We will have covered the subject matter by then. Often the interactive questions get us even more. Steve, a little bit about you, my friend. First off, yeah. I need to say thank you to Steve, a good friend of mine, Jeff Dunham, who owns Dunham Trust. I was lamenting one day that we bank with a large national bank. I've been at the same branch for 37 years. That branch has changed its name 3 times. Now it's a 4-letter word, and it's a large national bank. They were unable to get us processed. They actually sent me and a bunch of my friends applications literally an hour and 10 minutes before they closed off the application dashboard. During that time, just a couple days before, I was lucky enough to have a friend introduce us to Endeavor through Steve and his partner, and they were able to be our saviors. So Steve, to your team who are incredibly kind with us, thank you for having a regional bank mentality.
Well, with that, I don't think I'm going to introduce myself. There you go.
That says it all, huh?
My partner, Dan Yates, and I started the bank about 2 years ago with what you just described in mind. We feel like that business owners, owner-managed companies are best served by a local community bank, and that's who we are. Roughly 95% of our investors are all Southern California business owners. Roughly 95% of our clients are all Southern California businesses. We believe in local, and we think it makes a difference, and we think it showed during this PPP process. So that's who we are. We're all about local ownership, local control, local decision makers, local clients, and we bring our consultative approach to the local community.
Cool. Thank you, Steve. And for our next presenter, Jim, it is when you're looking at re-onboarding your clients or not, having an HR company that understands not only the rules, but also how to keep culture and balance the rules, culture, and good business decisions. Jim is an expert at that. Jim, tell us about yourself.
No, I appreciate it. Thank you. And thank you for having me today. So as mentioned, I'm Jim McGowan. I'm the CIO, Chief Innovation Officer at CultureWorks.
Sorry,
We're a boutique, that's all right. We're a boutique fractional HR company serving all of Southern California. And we partner with small businesses. Through the lens of HR, we really focus on values and culture to help those companies align their company culture with their business goals. And when you do get values-based decisions with all levels of a company, really great things can happen. So I'm excited about the opportunity to talk about how bringing employees back in this unprecedented time could positively or potentially cause some challenges to small businesses.
I was on the phone this morning again with one of my great clients, a manufacturing company that is having issues because of the COVID and what's going on that's in the aircraft industry. They have a legacy company. They went from 210 employees and downsized to 170. Most of the 170 have been with them over 15 years. And now the question is the survivability of the company, taking care of the rest, legacy employees, newer employees, which talent, what not. Jim is great at helping a client think through that.
Thank you.
And then, of course, we have Caroline rejoining us. I'll let you know that Caroline is a fabulous CPA, partner at Squire Miller.
She's not actually a CPA. She's an
Yes,
attorney.
an attorney at Squire Miller. A regional CPA firm that we've worked with for a long time. The type of firm, though, I was working with one of the partners on presentations like this, and they're the kind of firm that says, you need the best of us. Keith then said, you need Caroline. Caroline, after hours, was kind enough to respond. She participated on one of our calls before and had one of the highest ratings that we've had in the last year. So Caroline, welcome back.
Yeah, thank you. It's a pleasure to be back here. And like you said, I mean, I want to echo what Steve and what James has said in that, you know, it is valuable for us to be able to provide this sort of information to the middle market. By way of background, a lot of my background, so out of my 22 years of experience, 14 of those years was spent with a Big Four firm and primarily with Goldman Sachs. So, you know, I have experience with the big banks, the big firms, et cetera, in New York and Washington, D.C., which is the reason why my firm tapped me to be the leader, the subject matter specialist with respect to the PPP loan and all things regarding the CARES Act. But with respect to that also, I've also been on the industry side. So I spent 5 years in private equity. And then after that, I was fortunate enough to enjoy a couple of capital events. And it enabled me to join a startup venture. So I had a good amount of time and some very, very great experience on the operational side as well. And so what drew me to Squire Milner, which I suspect is kind of like the underlying theme of everything here, is the desire to really bring kind of top-notch, you know, big company expertise to the middle market, and that's what really brings me joy and makes me feel like I'm giving back and doing my part. So a pleasure for me to be here and help again.
So with that, you've got a bias for each one of the four presenters today. You've got a bias for each one of the four presenters as well as knowledge base. What you're seeing now on May 28th beforehand, we did how to best utilize. Today we're talking about most recent developments. Oddly enough, we have a recent development that just happened. Caroline, what just happened?
So just as we thought, maybe we might have had a handle on the PPP loan forgiveness calculation as well as the mechanics with the advent of the loan application. Last night, it might be, some people consider it a good thing, some people kind of like look at it as a curveball, but last night the Senate had passed the House version of what's called the Paycheck Protection Program Flexibility Act. It is now sitting on the desk of President Trump, and we'll go through, I guess, a little bit later in the presentation as far as, you know, some of the key changes. So in the event that the president signs it, and all signs right now currently point to yes, he will sign that by the end of this week, we'll be talking about, you know, kind of like the practical things that we need to be thinking about in terms of our business.
So our slides that we have today are based on the law that already exists, but for these changes, because we don't know if he'll sign it the way he does. But we will talk about those modifications. We were talking beforehand, and what every participant on the phone or on the call should know is that the pundits, the people that are talking about what it is, are interpreting what that law says, absent what the SBA is going to tell us what they think it says. The SBA's interpretation of what it is has often not reflected what the actual law was, and they've changed their mind under frequently asked questions, answers that they've produced over time. And after that, the industries that you now see on here within HR, banking, lawyers, and accountants have reached back and said, that's not what it says, you've got to be kidding me. And then they've modified it again. So if you're a business owner feeling like you're getting new answers every week, every other week, every other day, the better your advisors, the more often you're getting new advice, because it has changed and because the interpretation has changed. We all agree that this will take about 2 more weeks to settle out as to what it is, and then over a month more on the fine points. But you should know enough to make sure you're making great business decisions. Getting your entire loan forgiven may not be the best decision. And I know that sounds counterintuitive. But of course, we're going to talk about how to do that as well. Our next slide, and of course, June 11th, we're going to talk about what happened in the value business and what do you do about it now, and then we'll have other programs as we go along.
So first question, how do I get the most forgiven, or should I? And we have Steve's going to address these questions. So Steve, I'm going to go ahead and move into your slides.
So Mr. Banker, do you have a lot of clients wondering how to get most of it forgiven?
Well, I think the dominant share of my clients want to get it mostly forgiven. There are some outliers that are questioning whether they want to get it forgiven, but really I think most business owners do want to get the most forgiven that they can. I put up some questions here. Should I take the PPP loan or not? A lot of that comes down to the 2 tests. I call it the needs test and the use of proceeds test. The needs test was a big one at first, before some, as our host mentioned, the frequently asked questions that came out to give what I call the get out of jail free card for all the borrowers with a loan amount less than $2 million by signing the application and their rep and warranty that they need the loan. They're being that's a given. For the loans over $2 million that are going to go through the automatic audit, which I'm sure Caroline will talk about a little more. They're going to go through a process of qualification, and then if they were deemed to have gotten a loan that they didn't need as determined by the audit, then there'll be no harm, no foul, they'll pay it back. The bad part about that is I've heard since then, since they issued those frequently asked questions rulings, that they've been now speaking out of both sides of their mouth. So I would encourage, even though we do have some element of belief on that point, on the needs test, I would still encourage business owners to really document your need. Document your, whether you do or don't have other sources of liquidity. That was an important one, just that your impact for needing the loan. And if we can go ahead and you can see the questions that I pose. Those are really, these bullet points are really the most frequently asked questions that I'm getting from my clients. So I just thought I'd put them up there. So if you want to go to the next slide. I thought I'd tell the story by telling stories. That's the way I do it. And this is a real case of one of my clients, a very large nonprofit. They have just under $2 million PPP loan. They're doing very well, contrary to a lot of businesses. They're ahead of budget. They have a $2 million rainy day fund. They don't don't even anticipate needing to touch. And they're really wondering, do they qualify for this under the needs test? They're very satisfied now with the new rulings, but they're really questioning whether they want to keep the money for the 2 years. It's now been extended to 5 years, I believe it is. Caroline, you can correct me if I'm wrong, as that's one of the changes in the law that is going through, and keep it for the long term as a very low interest rate loan. I think they're going to decide to do that as opposed to using it to pay back. I think they want to use it to give back to the community as part of their nonprofit function. But now they have a longer term to decide if the market, which they depend heavily on fees from investment services, so they get to determine that the market, stock market holds up and their fee income and revenue holds up, to make the decision of whether they want to apply for forgiveness or not. So they have some more latitude with the changes in the law. So these changes have really come their way. But the big key to this is document, document, document. I think most of you probably have been told and heard that you need to open up a separate account, or it's best practice to open up a separate deposit account, keep this money segregated, so it's even easier to document the use of proceeds. That's the second test that I referred to. If you want to go ahead and move to the second example.
Yeah, Steve, sorry to interrupt. I just wanted to clarify one thing. With respect to that extension of the maturity date from 2 years to 5 years, that extension only applies to loans that are entered into after the enactment of the PPP Flexibility Act. So it does not change. So if you already have a PPP loan outstanding that carries with it a 2-year maturity, that maturity does not change. Again, it's only with respect to new loans that are entered into after whatever date that the president signs this into law.
You know, I forgot to say that, thank you, Caroline, for that clarification. I forgot to say that I've been contradicting even myself as this time frame has gone along, because the loan is changed, the whole process is changed, sometimes daily, sometimes intraday. So it's not unusual. And I even asked Caroline and our other panelist, James, to go ahead and jump in and correct anything that comes up, because being that the law just changed last night, we're going to have contradictions as we go. So I appreciate that, Caroline.
Yeah, sure. And Steve, just one more thing. I think that a lot of people don't appreciate that the banks are getting dragged along just like the borrowers are, right? I mean, the SBA is charged with administering it, but basically, the SBA and Congress didn't ask the banks to go along with it. They kind of mandated it and said, hey, you know what, you guys are an SBA lender, you're going to do this. And so you guys have been kind of, at the mercy of the law changes just as well as the borrowers.
Yeah, we're all in this together, and we're all being dragged along. If you can tell, my voice is a little bit raspy. I lost my voice through this process, and it's never come back. So I'm hoping that I recover. But the second case study is exactly the opposite of the first one. A large restaurant operation with many locations. You can imagine they also have a wholesale piece, a manufacturing piece. As you can imagine, they've shut down all of their locations. Almost all of their employees were staying home, and they have a large number of minimum wage employees. And minimum wage, and there's a tax credit that Caroline can speak to later that's available, and you can't take both, tax credit and the PPP. So they're really struggling between the two programs of which one to take. And this gets to that question of, do you ask for forgiveness at all? And they're wondering if keeping a loan for now 2 years instead of 5 years that we just learned is the best thing for them to do. Keep it as a low cost use of capital, can use it for the covered pieces, the payroll and the other covered items, expenses, but instead of asking for forgiveness, to keep it and go for the tax credit for their very low wage employees. And they're still struggling with that answer. I don't think they've come to a conclusion yet. But this is the exact opposite of the previous example. The bullet point about the covered period running out, they've got a respite on that, as we know. The covered period is extended to, I believe it's 24 weeks. So they've got more time to work through this, more time to get their locations open back up. From a cultural standpoint, they didn't like the idea of using the PPP loan to pay employees that were staying at home. They were struggling with getting employees to come back because employees were, in some cases, making more money on employment than they were making working for the business. They don't like the idea of those employees waiting for them to come back because they don't want to come back now. So they've got some real culture issues. They've got some issues of paying people for staying home. They've got some tax credit issues that they're weighing versus using the PPP loan. And with this extension, it gives them a lot more flexibility to get open, get their employees back, get them paid under the program. Go ahead and switch to the next one. Next slide. So this one, contractor, in the Wall Street Journal article that I read today covering the changes in the law that were passed last night, it really indicated that companies that didn't have to lay off their employees had got more benefit out of this PPP program. The slide where companies that had to lay off all of their employees because they had to stay home. So this contractor, his sales were not as impacted as others, but his collections are really slow. We're starting to see delayed projects, so the needs test is definitely starting to kick in, although if you look at his financial statement, his revenues and profits held up. He wants to know if he can squeeze in multiple payroll periods from before the covered period and after the covered period. I think Caroline can confirm that it's not it's accrual basis on the covered period, and you can't squeeze in multiple payrolls like he's looking to maximize his forgiveness. He's going to meet the test on payroll dollars. He's going to meet the test on this 25% for covered expenses like utilities and rent. He really doesn't need the money in the sense that from the needs test, he has plenty of liquidity and an unused line of credit. So he has some concern about that, but because his loan is under $2 million, he's going to roll with the original advice that he's going to have a get out of a jail free on that rep and warranty. So he feels comfortable that he can maximize his use from payroll and for the covered experience. And I'm pretty confident he's going to get 100% of his loan forgiven. But with that, I will pass this on to the next.
I've got a couple. Let's go back one. So if I was the 25% on the vote, example 3, there it mentions 25%. Either Steve or Caroline, can you talk about that 25% number?
Well, it's now 40% with the change in the law. It's been, and I will say all of these changes from my perspective, even from the very beginning, have all come to the business owner's way. It's my experience that's 2 steps forward, 1 step back typically with these kind of programs, but this one has been all steps forward. And with this 40%, it really covered for non-payroll expenses, utilities, rent. Caroline, can you help us with some of the others? I don't recall.
Sure. So non-payroll approved, I guess, PPP loan expenditures includes mortgage interest payments for loans that are secured by real property or personal property that was entered into prior to February 15th of 2020, rents and leases, and that is for facility rents and also for personal property rents. So if there are business vehicles, et cetera, or capital, or like equipment leases, et cetera, that is also allowed as an authorized non-payroll cost. And then finally, with respect to utilities, a lot of questions there about what is a utility. Right now, that definition is limited to electricity, gas, water, telephone, but not cellular phones, internet, and fuel for business vehicles.
So, Caroline, 2 things. Does that include my copier lease and the lease on vehicles that are out in the field for me?
Yeah, so with respect to copier leases, I believe that the answer to that is yes. With respect to vehicles, so business vehicles, the question there is a little bit further, meaning it's supposed to be a vehicle that is used in the business. Meaning if you have an automobile allowance, right, for example, that is not going to be W-2 income. That is not going to be included in gross wages for any of your employees or any of the people that receive compensation for you, then I don't believe that that is included. However, if it's a business vehicle that is truly used in your business, for example, if you have a mobile grooming business, if you have a delivery business, if you have a food truck, something like that where the vehicle truly is integral to the performance and operation of your vehicle, then I believe that the answer to that question is yes.
Percent went to 40%. That 40% got an extended period of time. So this additional period of time, rather than the 8 weeks, is that to use the payroll money or to use the approved other expenses money?
It's to use the entire PPP loan proceeds. And the requirement is that any of those loan proceeds is supposed to be used to the extent that you're gonna ask for forgiveness, right? If you don't ask for forgiveness, then the question is kind of out there. But assuming that you're gonna look for forgiveness for all of the PPP loan proceeds that are actually spent during your now 24-week period, your 40% is the non-payroll eligible cost, and the 60% is going to be your payroll cost. Now, I will make this one mention. The way there is apparently what some people are calling an error in the drafting of the new act. And the way that it's drafted, it says that if you exceed 40% of your PPP loan expenditures for non-payroll costs, meaning if you don't spend at least 60% for eligible payroll costs, then none of your loan will be forgiven. We are all hoping that that is a Scrivener's error and that will subsequently be corrected by the SBA and or the Treasury in the form of regulations or FAQs or an interim final rule that will be issued in the next, hopefully, couple of weeks.
So many of our clients, because of this extended period, are going to have just the payroll will cover all of it, correct?
Ideally, I believe so, and I believe that that is in line with the spirit of the PPP program, which is to spend primarily for payroll. However, there is the reality, and I think that Jim is going to touch on this a little bit more from a practical standpoint. There is the reality that there are certain businesses that are completely precluded from continuing operations, and from that perspective, does it or does it not make sense to bring back any level of employees to essentially do nothing? So, so that's one of the operational questions. It's kind of a chicken before the egg thing in terms of determining that.
I have a couple more questions that have been brought up. Somebody's brought up this, I can borrow $100,000 from my retirement account. Is what my ability to borrow that money or not at all connected to any of these loans? Caroline, there's this, I get to borrow $100,000 from my retirement account. That law and rule, is that connected to any of this PPP loan at all?
Not to my knowledge, but I think that whoever's asking that question needs to check with their retirement plan to make sure that, my understanding is that ability to borrow kind of penalty free out of the retirement plan is something that is authorized under the CARES Act. However, I'm not certain as far as the interaction or the preclusion, vis-a-vis the PPP.
And then we had one more question before we move on, at least one more so far, which is the, there's been this FTE 40-hour, 30-hour thing, and it's gone back and forth. Where does it sit now?
It is at 40 hours,
So
40-hour average.
FTE, if my employee worked 30 hours a week on average during that time, then I either get to choose them as a half-time employee or I get to add up all the 30s and divide by 40?
You can do two things, right? They allow you, anybody that is less than 40, you have the option of using them, counting them as 0.5 if you don't want to do an actual calculation. However, in this situation, because you want to get as many FTEs as possible, so to the extent that you have 30 hours or more, if you have a lot of people who are over 20, I would say use the actual. If you have a lot of people who are under 20 hours, right, so you get to round up by using the alternative, safe harbor method, by counting them as 0.5, I would do that. So again, the game is to get your FTE full-time equivalent employee count as high as possible.
We're going to cover FTE a little bit more. So I think we're up to Jim next. Is that true, Shelley?
It is. Pros and cons of bringing back employees. Oops.
So Jim, I was on the phone today with a company, again, a manufacturing company. They went from 210 to 170. They've got historic legacy employees that they care for, but if they kept them all, they would go out of business. They were going to have about $1 million not forgiven by the old calculation. Now it looks like it'll be all forgiven if they keep and move, but they've got an FTE thing. They've got a culture issue. they've got new executives, but they've got loyal old employees, and they're feeling the quandary, and it makes them sick to their stomach. Is that unique for you or kind of common?
You know, it's like you just described a case study of what's happening for probably most companies around the U.S. We're just seeing that across the board. So, you know, and to segue into that, you know, when, you know, my portion of this presentation is really talking about, you know, does it make sense to bring back employees during this time? And so there's a couple of assumptions that are made that to the point just made that, you know, there are employees that have been laid off, and now you're faced with a dilemma on should I bring them back or not. So, you know, the very first priority right out of the gate, you know, it's not about the PPP, and it's not about bringing back employees or not bringing back employees. It's about keeping the company in business, because if the company, you know, does not maintain itself as an ongoing concern, the rest of it's a moot point, and nobody can come back anyway. So, you know, I actually have been, like we all have, been through a lot of different webinars, and this was some great advice that I got from one of my colleagues. You know, don't make a decision just based on the fact you can get free money. You know, make the decision about the PPP and bringing employees back based on if it's good for your business. And the fact that the loan is a great benefit, as Steve and Caroline have both talked about, but that shouldn't be the sole objective. And it's a good loan whether or not it's forgiven. And so with that kind of out of the way, if you want to go to the next slide, I'll talk about how that relates specifically to the employee pluses and minuses. So first and foremost, you know, just practically speaking, does your municipality even allow you to return to work? Now that, you know, similar to what we're facing with the PPP, the seemingly ever-changing PPP rules, that's the same case for the municipalities giving us guidance on what's an essential business, what is a non-essential business that can open and whatnot. So at my company, we are literally checking the county ordinances, and we primarily support Southern California, so that's where we're looking at, you know, San Diego, Orange County, LA, Riverside, to see what the latest is around what the return to work ability is for a company. So, you know, if you can, in San Diego, a lot of the company, and the momentum is starting. Now there's a lot of organizations that are allowed to return to open and to come back to work, but start with there. Make sure that you're allowed to open, because even though the county may make a determination, there could be a subset of the city to make that determination as well. So let's assume that your municipality allows you to go back to work. So here's the question now. You're now, okay, I'm going to bring back the employees because I have the PPP. I can pay them with the funds that I have. But we are challenging our clients and companies out there to assess whether or not is there work to be done, kind of like the case study that Steve talked about. You know, do you want to have a case study, or pardon me, do you want to have employees that are that are being paid to do nothing? Now there is an argument for that, and my argument for that would be you don't want to pay them to do nothing, but if there is not work to be done, this might be an opportunity for some training and development. This might be an opportunity to implement some, look at your warehouse and configure some total quality management or some lean configurations and kind of reconfigure things. You know, you have this little window of opportunity at, spring cleaning, leadership development, and the like. Again, I wouldn't make that as the primary reason to necessarily bring someone back if you don't have any work. But, again, if your business has the resources, you can bring back people. You've got a forecast of work that's going to happen, and there's just like this, this window where there's not a lot going on, but you have an opportunity to do some training and development. Then it might make sense to bring those employees back. But if there isn't work to be performed after the PPP is exhausted, culturally speaking, you are now putting that employee on a bit of a yo-yo. They were working and now they're not working, and they're claiming unemployment benefits, and now they're back to work, but that's only going to last for a while. Then they're back, on unemployment. It's a very stressful for both for all parties involved. And so you really should look at, you know, again, can the business actually put those people to work so that they're contributing to whatever that product or services that the company creates. So again, assumptions. The city or the region where you're at allows you to open. You do have work that's to be performed. So now you've got to decide, or now you have to actually take some practical steps to make the facility actually, ready for those employees to come back. You've got to clean it, and you got to sanitize it. You got to potentially close common areas, maybe lunchrooms, break rooms. Maybe there were certain outdoor spaces where, you know, employees would congregate on breaks. All of that needs to be assessed and reconfigured to meet the needs as dictated, or the requirements as dictated by the municipality where the business is. So then you got to reconfigure the spaces. If you, we've seen a lot of collaborative workspaces where they basically cut capacity in half because every other seat has been, you know, blocked off with tape, or chairs have been removed so that there's that 6 feet of spacing. So you, not only do you have to reconfigure, you have to kind of assess for you as the leader of that organization, you know, can we still perform the functions that we need to under the requirements of the spacing that we're required to do. So again, just considerations for getting the facility cleaned and prepped for the return of those employees. Now, the big question about that is, can you afford that? You know, maybe you had a janitorial service or a porter that came in, you know, once a week or a couple times a week, and now, you know, can you afford to have either your own internal team or an outside service coming in daily, cleaning in between shifts? If you're gonna, and I'll talk about this in a little bit, but staggering shifts. And so you've got, a morning shift that's working, half capacity, so to speak. Then you've got a cleaning team that comes in to sanitize and clean everything. And then you got your afternoon shift. Again, can you actually afford that? So again, back to square one. Is this a viable option for you? And now if it is, all that much better. This is great. I mean, we want to get people back to work. But what's really important about the cleaning and reconfiguring from a culture standpoint is you got to really show those employees, you mean business, you care about their safety, and you're taking this serious, and you want to make sure that the facility is conducive to not only protecting their health, but again, producing the product or service that the company produces. So now you've cleaned, you've reconfigured, you've hired additional either internal staff or external staff to keep that ongoing efforts. Now you've got to update your company and facility policies. For example, right now in the county of San Diego, all businesses are supposed to do temperature checks prior to allowing employees to come into the facility. And if they have a temperature that exceeds 100 degrees, they're not allowed to come into the facility. So are you going to, do you have a way to manage those employees coming in through a single entry? You also have to take into account payroll considerations, because if you're requiring that employee to arrive on site for a 7 a.m. shift, but they need to stand in line for 15 minutes before it's their time every 6 feet to get a temperature check, you're actually going to need to override their clocking in, since the time clock is on the inside of the building, to make sure that you have accounted for the time that they have spent waiting in line to get into the facility. So there's a lot of coordination that's required in order to support these new companies' policies and procedures. So you got to update them, and then you got to communicate them, and I'll talk about that in a little bit as well. So one of the big recommendations is, like we've seen, like with restaurants that are opening, is that they're 25% capacity or 50% capacity. That's what's being recommended for a lot of companies. So again, is it a staggered shift? Is it a shift where if your business is conducive to work from home on Monday, work in the office on Tuesday, work from home on Wednesday, If you're a manufacturing facility, is it, morning shift and the afternoon shift, whatever the case may be. So can you, number one, can you support that? Do you have the supervisory and managerial staff to manage that tiered schedule and whatnot? So that's a big consideration and concern. Just to kind of wrap this up, the big one too, and this is the thing that we're not all necessarily, we're all so eager to get back, and trust me, I am at the front of the line. But when all is said and done, you as a company need to be prepared for the possibility that now that we're all back in the office, that unfortunately someone brings it into your facility. They have been exposed. Somebody at home has been exposed, and one thing leads to another. Now you've got either a reported case or a potential reported case at work. So, we are highly recommending that you create that policy around what are you going to do? Okay, you're going to obviously send that employee home. You need to obviously keep from a HIPAA and privacy protection. You want to keep that confidential. You want to let the other people know that have been exposed, and so on and so forth. And then lastly, kind of echoing what Steve said, will low-wage employees even want to return to work if they're receiving higher unemployment benefits? There's a million reasons why they should, but Carolyn actually talks a little bit about this. But it's hard when someone is low-wage and they're going to make more money in unemployment, and they don't necessarily care about what's going to happen in 6 months or at the end of the year or in the future. So, but there is a benefit for the company that I think a smarter person than me can talk about in the next session.
I kept on saying unmute me, but I don't get very far.
No, because he messed with the slides. So
Joe is playing with the mouse.
Yeah, I was like, what are you doing?
Jim, thank you. Next, please.
Jim, I wanted to ask one question. What about the mindset of these employees as they're coming back? How do employers help employees literally come back to work? It's a challenge. Just having been through it for 10 weeks, the idea of moving back out into the real world and being around people and in public again is different. What should employers do to help?
So here's the analogy I'll use. In the same way that you've heard Steve and you're going to hear Caroline talk about document, record everything so that when there's an audit or there's you have a paper trail and so on and so forth. As it relates to employees, it's communicate. I mean, you've got to, and it needs to be frequent. It needs to be concise. You need to kind of anticipate the questions and concerns that those employees are going to ask, and you need to get out in front of it. You need to post things around the facility about handshake free zone, or remember to wash your hands. Pulse check, midday pulse checks where there's some sort of kind of a company meeting where the leadership talks to we're so glad talking about how fortunate we talk a lot to our clients to explain to their employees how fortunate it is that we even have a place to come to work. But that doesn't mean that we still don't have to be careful and we have to be safe. And so it's all about communicating a message, communicating that the company cares genuinely about the employees, and that if as Steve said, we're all in this together, and if we work collaboratively and we work smart, we're going to get through this, and when we get to the other side, the company will survive, the employees will have jobs, and we will be on a much better economic recovery.
What do you think should be done about the rumor mill? A client came to us recently, a little over 200 people in their large facility. The rumor mill had suggested that if the employee took sick leave, they would get 2/3 their pay and unemployment that would be more than if they were to stay and get paid. And they mixed a bunch of rules. And by the end of 2 days, they had 20 employees that left planning to do this, but it wasn't necessarily true. But the employer was afraid to try to relay the information for fear that they were pressuring one way or the other. Any ideas, either Caroline or Jim, on that stuff?
Or Steve. Yeah.
Or Steve?
So I'll just jump in real quick on that. So again, it's at first indication, and first, number one, anticipate that that's going to happen, especially for hourly workers. You know, it's out there. Oh my God, I can get more money and I can sit at home than if I'm working. So you got to get ahead of it. You got to, and things that need to be explained are, number one, if you attempt to take your 80 hours from the Family First Corona Act, that needs to be documented. And there's only 6 categories that'll allow you to actually take those 80 hours. Number two, if you, by refusing to come to work for work that you are being offered, you are actually at risk of being denied your unemployment benefits. And you may get your unemployment benefits, right at the gate because there's so much chaos right now. But it always catches up at the end. When the government reconciles their books, they will go after the excess unemployment that was made. So, anticipating those, and then as soon as you hear about that, you got to get some sort of company-wide, almost a fact check. And it's got to be, you need your marketing team to wordsmith it so it's not aggressive and angry, but it's about, read the latest. Here's the latest. Here's what's going on. Here's why we care about this.
And how about the misunderstandings of the 2/3 versus sick versus supplemental versus 600? Caroline, you have any thoughts on that stuff?
Yeah, so I think that the question here relates to the FFCRA, or the Family First Coronavirus Relief Act, and that is that is separate and distinct, and in fact mutually exclusive from the PPP loan. So we want to make sure that we make that distinction, meaning that any wages or any compensation that is paid under the FFCRA for either emergency paid sick leave, or for emergency family medical leave, that includes folks who are either caring for folks who have COVID or who are seeking diagnosis, but also those who have school-age children who don't have childcare at this point in time. So again, after we make that distinction there, with respect to the folks who are getting this FFCRA, the employer does have a tax credit for that. That's number one. Number two, I couldn't echo more what Jim, sorry, I keep calling you James. What Jim is saying is, you do document to make sure that, hey, you know what, these folks who are in these situations, who are legitimately, have these concerns and have these legitimate rights, et cetera, are, that you do document that. And then from a PPP loan perspective, making sure that those wages are not double counted. What I mean by that is that the wages that you pay under FFCRA that you are entitled to an employer credit for from a payroll tax perspective is not also included in your eligible payroll costs for PPP purposes. Those are, again, mutually exclusive. So that's the distinction I think that we need to make there.
And do any of you know about when somebody gets the 2/3 pay for the family leave, let's say to take care of their school-age child, can they apply for unemployment benefits for the extra amount from the 2/3 to full and or the rest? Any thoughts on that, anybody? So I think that's a bit
That's a great question.
Right. That is a great question.
Kind of a dangerous area. And as an employer, be very careful what you're relaying to your employees about the rules are. If you are dead to rights and you know what they are, that may be one thing. But having an outside source, your payroll service that's willing to disseminate things to your employees, et cetera, to help might be a better answer. If an employee,
can I make one
Yes.
comment on that? Just my word of caution there is that the relationship between the employee and unemployment benefits, you want, as a company, you want to stay out of that. So you can guide the employee, you can share information, you can show them what the web pages are, you can provide, here's the documentation, here's the labor posters and whatnot. But the problem is if you sit with the employee and you walk them through, their application for either partial or full unemployment, and anything is wrong with that application, that employee can come back and claim that you are at fault for them not getting the benefits. So you want to provide information, but you don't want to be the counsel on filling out the unemployment information.
I'm going to answer a couple of these questions. There was one that said, What about employers' liability for having an unsafe place? What if an employee gets COVID while coming to work for you? If you followed all the rules, I think you're pretty good. But if you don't take temperatures when employees come in and you were required to do so and then an employee gets sick, I think, and there's no clear rule on this other than the normal rules about safeguarding for our employees coming in, I think if there's a rule about making sure that you take temperatures and you don't, that's a problem. If you have a rule that everybody does and you're taking them every day for everybody and somebody slides through by being sneaky, less of a concern. As far as if you paid an employee more hours in one pay period and then they quit, can you deduct it for later on? If you did so because you were trying to get more forgiven, you're included in fraud. And please don't compound it by trying to have it forgiven. If you did it by accident, that's normal employee law. If you accidentally overpaid somebody and you get with them by email and you have an agreement that you overpaid and you're deducting it, I think you're safe. That's normal EDD rules. If you overpay somebody knowingly, it's their friggin' money. Can funds be used for new employees? Yes. But remember, we're about to talk about FTE stuff. So can the funds, in order to be used by new employees? Yes, but if you replace somebody who isn't coming back, that's going to affect your FTE. If it's a new rule, that's a different deal. I think, Caroline, we're up to you. Unless, Caroline, was there a question you'd like to answer verbally?
Two more just came in. Do you have to put PPP funds in a separate account to avoid commingling? I think that's you're probably going to cover that, Caroline.
Most bankers have suggested.
Yeah. This is Steve Sefton. We were recommending that to all of our clients. Some didn't. It gets back to that document issue. But we just think it's a good best practice.
Caroline, do you know about this employees and being subject to or not subject to a class action lawsuit for the employer?
No, I think that's going to be an EPL question. So that's more employee law than it is a PPP question. So I would direct them to their employment counsel.
And again, to be incredibly clear, follow the rules. Don't go around them. Spend the money on the scanner for the temperature. Follow the rules. Offer masks for employees. Offer it for the rest. And if you're the owner, please set by example.
So let's move on to Caroline. And this is as we talked about, Caroline, this is a really big question to try to encompass. So please share with us what you have here.
Yeah, sure. So the question,
Caroline, has any of this changed?
All of it's changed, and it's continued to change. Except for the tax implications. So the one thing that we know, and the one thing that hasn't changed for better or for worse, right, is the way that the income tax is being treated on this. So the number one question, so I'm going to take the question backwards, right? The question is, how will this impact my business, my income, and my taxes? The tax piece of it, we'll take that first because it's a little bit easier to answer. So the questions that I'm asked so often are, will I be taxed on the amount of my PPP loan that is forgiven? Well, the answer from a federal standpoint, so from a federal IRS income tax standpoint, is no. To the extent that your PPP loan is forgiven, it will not constitute what's known as cancellation of debt income that is normally taxable for U.S. federal income tax purposes. And the reason for that is that the CARES Act itself actually includes black letter law that says that this is exempt from U.S. income taxation. However, from a state perspective, the answer is it depends, right? So certain states have a rolling conformity and other states have a static conformity, and other states don't conform to the Internal Revenue Code at all. For example, I'm just going to address California, which is where, we all live and we breathe, and we know when we love or not love. But California has a static conformity, meaning that it does not conform to the United States Internal Revenue Code for any laws that are passed after January 1st of 2015, and that includes the CARES Act. So unless California changes its provisions for California income franchise tax purposes, the amount of your loan forgiveness will be subject to California income and franchise tax. So there's going to be a difference there between federal treatment as well as state treatment. Then here's another rub, right? The IRS. The IRS is kind of getting dragged along with this also. Some of you will say, well, hey, you know what? The IRS, isn't it connected with the Treasury? Isn't it connected with Steve Mnuchin? Isn't it, you know, et cetera, et cetera, et cetera? The answer is yes. However, the way that the laws are written right now, it says, well, you know, you're going to get forgiven with federal money of these loans. And so there is there is an IRS code section, I believe it's section 295, that says that if it's paid for with government money or any other tax-free money, that you don't get a tax deduction for it. And so what that prompted was, at the end of April, the IRS issued what's called Notice 2020-32, and it says that to the extent that you paid for these business expenses, so payroll expenses and mortgage interest expenses, lease payments, as well as the utility payments that are paid for with funds from PPP that was ultimately forgiven, we're not going to let you take a tax deduction for it. Well, that has put everybody up in arms, because what that does is it essentially erases the tax benefit of the forgiven amount not being subject to income tax, right? So you're basically at a wash. You're not getting what Congress, or at least the senators who are very vocal about it, have said. This is not the intent of the CARES Act. We intended for it not only to be for the forgiveness, not only to be tax-free, but also for the taxpayers to get the benefit of these normal tax deductions. So unless and until the SBA or the Treasury comes up and says, and affirmatively issues regulations or an interim final rule, which it has not yet, then the rule is right now, the IRS has stated in its notice the intent that it will disallow these tax deductions. The good news is that we have a little bit of time. So, up until the time that you have to file your income tax return for the 2020 year, we still have time to see where the IRS is going to come out on this. So hopefully we'll get some guidance.
Caroline, can I jump in and interrupt
Yeah,
again? I just can't believe that this is going to stand. Do you have an opinion on this? I mean, this kind of just pulls the rug out from under the whole program as far as I'm concerned.
Yeah, no, I completely agree with you. And I think that conventional wisdom, and that means, the folks who drafted the CARES Act, the people who drafted the PPP loan forgiveness, as well as the PPP loan program itself, and also, us as practitioners and us as, taxpayers, essentially, all have a visceral reaction to the IRS notice. However, the IRS is within its rights, because the IRS basically, in my opinion, is saying, hey, we're going to issue this notice to prompt there to be some definitive regulations that are issued to remove the uncertainty. So in my opinion, or at least, and perhaps it's with rose-colored glasses, I'm hopefully saying that, the IRS is trying to say, hey, SBA, hey, U.S. Treasury, you need to tell us how we're supposed to treat it, because the way that it's written right now, we, the IRS, are mandated under Section 295 to disallow any of these tax deductions. So hopefully,
so like I said before, all the changes seem to be coming towards the borrower in our favor. So we can cross our fingers and hope that this will be the same.
We are crossing our fingers. What is the surprise is that the PPP Flexibility Act that passed in the Senate last night did not fix this.
And remember, this is going to be an attention span issue. What is going to draw the attention of our lawmakers away from this, because we're through it, because we're doing better, because we're not? There's going to be an attention span issue. Then there's going to be an election, and do you fix it before January or not? And you can get everybody to get there, or do you get a decree that does or not? And I'm going to get back to my attention span issue. I was really surprised, like Caroline was, they didn't address this in the most recent legislation. But remember where that legislation started. It did not start in a place that was pro-business. So, Caroline.
So this is kind of like, I guess, the safe harbors. And I think that this is touching also, again, on what Jim was saying about the decisions of, do we bring people back or do we not bring people back? And to what degree do we bring them back, and when do we bring them back, right? And so it goes hand in hand with, not only are we the employers, the businesses, able, right, like, physically to allow the workplace to be conducive to having folks physically within proximity to each other, but also, to have folks on payroll at certain points in time. So, with respect to this, the things that I wanted to point out are the reduction. So these are the things that will change or serve to reduce the amount of PPP loan forgiveness. And these in principle have not changed with the passage or the anticipated passage of the Flexibility Act. However, some of the dates may change. So the FTE reduction exemptions. So we say that any reductions during the covered period or the alternative covered period, which has now moved from 8 weeks to now 24 weeks, will not, so any of these things here that are bulleted, these events will not result in any reduction or it won't count against the employer if any of these things happen. Number one, first and foremost, is if the borrower issued a written offer to rehire folks, right? If they laid people off and they issued a bona fide offer to rehire the employee and the employee said, no, thank you, either because they've already found something else, either because they don't feel comfortable coming back, or maybe they're making more money off of unemployment. Whatever the reason is, if you can document that you've offered their job back and they did not, and they declined that, you will not be penalized. Your FTEE count will not be reduced for that. Similarly, any employees who are fired for cause, anybody who voluntarily resigned, and anyone who voluntarily requested or received a reduction in their hours. So as Jim had pointed out, some people just might not be comfortable. They might say, hey, you know what, I can't or I won't come back. Or I'll come back, every other day, etc. So if they do that and voluntary and something outside of the employer's control, you will get the benefit of the doubt for that. Something else that is not included in the law, but I truly believe very, very strongly from a policy standpoint that should be included, is people who are on leave, right? So if they are on medical leave, so if they're on FFCRA leave, right, because of COVID, or if they're there because of maternity leave or family leave or anything else, I believe that also those folks are not technically, they haven't been terminated. They are still employees. They're just not receiving payroll because they're receiving disability or some other benefits. Even though those payroll amounts or any compensation that they receive will not be eligible payroll costs for PPP purposes, I do believe that they do count as head count for purposes of your FTEE count. So there's that consideration. Next up with the safe harbor is the FTEE restoration safe harbor. And this says basically that if you had folks, during, from the period between February 15th through the end of April, and you reduce that headcount, right? So you had a layoff, you had, terminations, et cetera, because of COVID. But if you fully restore your levels by no later than, and this is the rule before, right? If you restore your levels by no later than June 30th, then you will not be subject to loan forgiveness reduction for that. The Flexibility Act that is soon to be passed, or we're anticipating that to pass, will change this safe harbor date to December 31st. However, that begs the question: what happens to those employers who got their PPP loans, call it in early April, and so now they did what they were supposed to do? They brought everybody back, and they were going to keep their full FTEE headcount levels through June 30th. But now they're going to run out of money, right? Because now they're going to run out of money, and they may or may not be in a situation where they have to perhaps reduce headcount between now and the end of the year. What happens to them there? Are they required, or are they going to be penalized because they're going to have to enforce a RIF or something else, and they haven't been able to bring everybody back at December 31st? Or can they still use the June 30th number? My crystal ball, hopefully, if there's any root in equity here, will say that, hey, you know what, the folks who received their PPP loans, call it before June 1st, should be able to still rely on their June 30th safe harbor date, at least in my opinion. Anybody who does it afterwards, who are able to plan accordingly and manage their cash flow for payroll and other things, and are able then to meet this full FTE restoration safe harbor by the end of December, should then be able to use that safe harbor as well. So that's something there's a reason why we didn't change the slide, was because, I do believe, again, if my crystal ball is correct, and it's been pretty decent so far, that I think that there would be some optionality there. So at least, fingers crossed, because I think that any other answer would unfortunately be inequitable. And then finally, I think that there's also kind of an echo there with respect to the salary and hourly wage safe harbor. That also similarly says that if you reduced anybody's salary, or if you reduce their hourly wage, not reduce the number of hours that they are allowed to work, but actually reduce their base pay or their base pay metric, then if you're able to bring them back up by June 30th, then you will not suffer the dollar for dollar reduction in your PPP loan forgiveness amount. And again, that date has been moved from June 30th to December 31st by virtue of this, the Flexibility Act. But again, I echo again what I said with respect to the FTEE safe harbor. Hopefully they're going to issue some guidance that says that you're going to be able to use and still rely on the June 30th date as well.
So Caroline, currently we don't have clarity on that. That was your crystal ball.
Yeah.
Do you anticipate the law will give clarity, or in the next 2 weeks we might get clarity? What by the way things have been going, when might an employer get clarity? Because these employers are now looking, saying, I've got a lot, I don't know if I can afford them, I've got to keep them. This FTEE thing can cause a larger, but I might have to release soon. How long do you think they're going to have to wait to get that clarity?
Right. I mean, ideally they'll do it sooner than later. However, right, if you do the math, the passage of the PPP Flexibility Act comes within the 8-week period of the first loans that were issued, right? So some people will say, hey, this extension from 8 weeks to 24 weeks is great. It gives us the opportunity to get full forgiveness because now we get to spend more money over that course of period of time. However, what that also does is it provides an extended window of time for the SBA, the Treasury, et cetera, to change the rules a little bit. So it kind of, so it can go both ways. We can get additional clarity, or we can also get additional uncertainty. And as we have seen over the course of 2 months, whenever it is that they've issued the quote unquote interim final rules, right, and the FAQs, more, it's kind of 2 steps forward, 1 step back. They will give clarity on some things, but then it will raise other questions. And I think that trend will continue.
Because we do have employers right now that have tried to keep their employees. They're still trying to keep them, but they haven't been able to go into full swing. So in some cases, some of our businesses can't open up for all the reasons that we know about, whether it be unrest, whether it be supply chains, et cetera, that makes them go longer. But if they keep all their employees, they might lose their entire business for everybody. So they're stuck in this quandary.
That's exactly right, unfortunately.
But it's very important to understand what Caroline's saying. There are these 2 different things to think about: crossing through the FTE gate and then crossing through the how do I spend it gate, that are related to employees. But when do I have to keep these employees to not bust my FTEE rule? But then how long do I have to spend is an unrelated conversation. Did I say that right, Caroline?
I think so, yeah.
So,
Another
no, was there more on the slide before?
No, we can go to the next slide. And the next slide is talking about the certification of economic need. So, whoops. We already finished it. So, do we have additional questions on this safe harbors? And if not, we can go to the next.
We have one. Caroline, can you see the question that just came up on the $150,000 employee that gets reduced to $75,000, but they were within that 100? Do you see that question on there?
Yes, I do see that question. I do see that from Laura. So Laura's asking the question and says, well, does it apply to wages over $100,000? What if an employer reduces an employee's wage from $150,000 to $75,000? What does that affect? Well, as you know, this is a great question, and it illustrates the rule. So the way that the safe harbor works for the salary and wage reduction works is that if it only applies to folks who are making less than $100,000 on an annualized basis. So if you have executives or any highly compensated employees who are making $100,000 or more, you can reduce them down to down to 1% if you want to, and not suffer a reduction for that safe harbor, or I'm sorry, for that reduction provision. However, again, if you are making, if it's somebody who's making, call it, $99,000, and you reduce them, then you will have a dollar for dollar reduction to your PPP loan forgiveness.
Great, Caroline, thank you very much. So,
so she has a couple more slides. She's got 2 topics. So certification of economic need, I think we were going to let her touch on a little bit, and then we'll open it up for more questions.
Sure. And this, I think that Steve had touched on a little bit in the beginning too, right, Steve? And we're talking about, hey, when you made the application, you had to certify amongst your, representations of the person who's initialing each of these. It wasn't just one of those fine print things that you sign on the bottom and oh, sorry, I didn't read it. You had to affirmatively read and initial next to each and every one of these representations. And I believe the second one was stating that the current economic uncertainty makes this loan necessary to support the ongoing operations of the applicant. And so that has been what everyone's referring to as certification of quote unquote economic need. There's been a couple of things that came out, right? And on April 23rd, 2020, FAQ number 31 says that you have to assess this. You have to make your certification in good faith. You have to, and it's the good faith was existing at the time of the application. And part of that is part of that consideration is, did you have the ability to access other sources of liquidity? And also, was it your ability to access this, would it have been in a manner that would not significantly be detrimental to the business activities? And they put in a specific example. It says that, for example, it is unlikely that a public company with substantial market value and access to capital markets will be able to make this required certification in good faith. So it's kind of alluding to, and it said, and once this FAQ was published, it prompted a lot of big companies, a lot of companies that were backed by private equity, a lot of companies that were publicly traded, Ruth's Chris and the Shake Shack, etc. A lot of them were prompted to return the money because of this guidance here. Then a couple of weeks later, the SBA published FAQ number 46 that says, hey, there's a safe harbor. If you have a loan that's $2 million or less, you know what? We're going to assume that you made the certification in good faith. So they went through here. I'm not going to read this entire paragraph, but it says that, hey, you know what? We're just going to assume it. You may still, we reserve the right to still review you and to audit you, but maybe not, right? It's not going to be mandatory. But with respect to the ones that have greater than $2 million, we're not going to say that you lied. We're not going to say that you couldn't make the certification. We're not going to preclude you. However, you are going to be subject to a higher level of scrutiny. So they provided then a safe harbor that was on May 18th, which is coming on, that basically says, hey, you know what? If you guys dig deep and look back on things and you really kind of like feel like maybe you couldn't make this or substantiate or pass the smell test on the current on this certification of economic need, and you pay everything back on May 18th, there'll be no questions asked, and you will be able to be eligible for other CARES Act benefits. For example, the employee retention credit, which you would not normally, which any other PPP borrower would not be eligible for. So there was that kind of split and baby. But I think Steve, and Steve might be able to elaborate on this, there is that kind of like one free bite, right? Because, with respect to this, if the SBA comes back and during the review period of your forgiveness application, and say you have an application of over $2 million, if the SBA examiner comes to you and says, well, I don't think that you could have made the certification in good faith, what say you, borrower? The borrower then has the opportunity to say, okay, fine, I'm not going to contest it, and write a check for the entire PPP loan amount then and there, and then it would be kind of like no harm, no foul. However, if they don't pay it back in full, then it's going to be a situation where it may be contested. Steve, do you have additional insight on that?
Yeah, that's what I call the get out of jail free card. That's our understanding. But since then, the SBA has been speaking out of the other side of their mouth. And I was a little bit surprised when my partner pulled me aside and said, they just said that, well, the FAQs that you're referencing here, they're guidance, but they're not, we don't have to go by them. And they started making noise that this was not definitive. It really disturbed me. So what I'm telling my clients is don't just relax. Document. I think the SBA is going to have a very difficult time not following these FAQs, like Caroline just said. I think they're going to have a very difficult time not following the get out of jail free card, as I call it. But I would still document and be prepared.
Yeah, Steve, I have a question for you. I actually have a client that is, it's affiliated with a publicly traded company. What do you say? And their PPP loan amounts are quite modest. They're well under the $2 million threshold. What do you say to them in terms of their ability, I guess, on its face, to meet the certification of economic need?
That's a tough one. These affiliation rules are pretty. the SBA affiliation rules tie you to your affiliation. So I would say that they have to follow the public company approach.
Yeah. Thank you.
Now, and both would say at this point, you're starting to hear some back and forth. It would be difficult if I was a business owner to rely on just one advisor. I would probably be talking to my CPA firm or attorney and my banker and double checking, or my HR company or my payroll company, double checking my advice. I'm sure that Jim, Caroline, and Steve have been on calls where a business owner has called in and said, I've been told that if and they give you this long fact pattern, which in essence sounds like they're going to skirt a rule. And because of all these connected dots, I'm going to be okay. I think all of us would say, as a business owner, if you get a long explanation of how you can skirt the rules and it doesn't feel right to you, immediately get an independent opinion by somebody who is that knows this area really well. The IRS, the SBA are not people to mess with on trying to skirt a rule. And remember also, it's going to make for great press to capture companies that took things that they shouldn't have. And I'll give you an example. I recently, last time I mentioned, I was on a call where a couple of CPAs were explaining to a client, you can apply for this, and because you didn't personally guarantee the loan, have the company do it, have the company spend it on these things, also pay down the things that you've got personal guarantees on, BK the company, you've wiped out your personal guarantees, and you're okay on the rest of the companies. Does that feel to people in the audience like you've done something wrong? Probably. So,
just a bit.
Just a bit. So if you're getting advice that feels like it might be wrong, either back away and don't do it, or seek other advice to double check. More often than not, these pieces of advice are connecting dots of pieces of rules and rules that are already in existence on tax law or on loan forgiveness or on employees. Be very careful with the connect the dot logic in something like this. Would that be fair, Caroline?
I completely understand. Yeah.
Cool. So next one, I think. Or is this the next one already?
I think, yeah, you have another page. Go ahead.
Yeah, so that's a great segue, right? To echo, I guess, what what Steve and what Joe were saying. What happens if my certifications are not met, right? So this slide is summarizing all the bad things that could happen, just in PPP world. Not talking about anything else with respect to the other ancillary things that happens. But in addition to your certification regarding economic need, you also certify that your funds will be used to retain your workers and maintain payroll or make mortgage interest payments, lease payments, and utility payments, right? So you're not going to spend these funds for anything else other than these authorized uses. So the first and foremost is knowingly making any of these certifications in less than good faith, including using your funds for any unauthorized purposes, will lead to dire consequences, including but not limited to the following. Number one, it will render the loan ineligible for forgiveness, right? Some people will say, big deal, it's a 1% loan for 2 years. I don't care, it sounds like a good deal anyway. Well, let's look at number two. Number two says that the loan will now be converted to a full recourse liability, right? That means that the SBA and or the government will now seek repayment of the loan, not only from the borrower itself, but also from its owners, its shareholders, its members, and its partners. It will also then say that, hey, you know what, it's not a 1% loan. It's going to be at whatever prevailing rate is for any SBA or any other, bona fide loan document. So that's the other rub. Also, if the loan is not immediately repaid, so this is the get out of jail free card, right? So if you want to play games, if the SBA guy comes in and says to you, you know what, I don't think that you met any of these certifications, your appropriate answer then is, okay, I'm going to write your check back. Here it is, all the principal as well as the 1% interest accruing from the date that the loan was dispersed. If your answer is anything other than that, if you want to take it to, you want to fight the good fight, et cetera, which you can, right? And I'm not saying that it's automatically just because they raise the flag that you're automatically precluded from defending yourself. But you do run the risk that if the government does not agree with you, right, that then civil and or criminal fraud charges can be brought against you, and that comes with it fines and or jail time. The last guidance that I had read was that fines were up to $1 million and jail time is up to 30 years in prison. So these are, again, dire consequences. The next question that I get a whole lot is, will I be audited? And the quote unquote audit comes in there, right? And the way that came through is because Secretary Mnuchin at the end of April went on CNBC and says, hey, we're going to perform a full audit on any company that borrowed more than $2 million of PPP loan funds, right? And people said, well, does he mean review? Like, does he mean like the forgiveness review, which we're all expecting, big deal. But, Secretary Mnuchin is in charge of the Treasury, which means that he is in charge of the IRS, which means that he can, theoretically direct the IRS or, cause the IRS to do a full audit. So the question then is, well, does audit mean more than a review of my PPP loan forgiveness application? Does it now mean that the IRS is going to go in and look at all of my tax filings? The answer is we simply don't know. So in the absence of that guidance, again, I think that the answer is document, document, document. And to echo what Joe says, just like stay within the rules, stay within the parameters of the rules as we know them, in order to avoid some of these dire consequences.
And just so you know, we are already experiencing, at least on one occasion, a subpoena for records. So they are looking already.
I think that the statistic is, at least from my research from over the weekend, I've seen 5 very, very high profile PPP fraud cases that have come through. One of them including a reality TV personality for basically getting a PPP loan and then squandering it on social media and buying cars and Rolexes and jewelry, etc. There's also been several business people in New York as well as in Texas who have been brought up on fraud charges. So to echo again what Steve is saying, we're seeing it here at the local bank level. There's also certainly going to be stuff that's going to be publicized, and you don't want to be certainly one of these examples, right, in the court of public opinion, right? You don't want to be on the cover of the Wall Street Journal or the Business Insider for a bad reason, certainly.
So thank you to Jim and to Steve and to Caroline very, very much. Thank you to those who have asked questions online that we've gotten back to. Thank you to my friends who've been texting us privately as Shelly and I phones have been blowing up as we've been also trying to get to those questions as well. Our board members who have put the series together, and Melissa, Melissa, you still on, Taz?
Yeah,
I'm here. Thanks.
Okay. Melissa, any final words for all of us?
No, I just want to say, or I think we want to say, thank you everyone for participating. Thank you to our speakers. They were fabulous. I think that this is really, really important information that everybody's looking for as the rules are changing and the guidance is changing continuously. I think we need to just stay in touch with each other and keep each other updated on what's happening. So thank you very much for participating.
I'm going to mention again to you, and of course I have clients on this as well that are great friends. These rules have been changing consistently. What was passed last night that is not yet signed into law, we are going to get clarity as soon as it's signed, but then more clarity as the interpretation from SBA comes up, as the interpretation gets reviewed again after the legal, financial, tax, and banking community push back, and as Congress pushes back. Remember, there's an attention span issue as well. Whether Congress, Senate, and the president would sign something to change it, whether the president would look down at the IRS or an SBA and say, you've got to be kidding me, whether we'll have attention span depending on other political and social issues come up, that's going to have all an effect on this. Remember, the rule was created to try to help keep our employees. The rule was created to try to help keep our employees. At the end of the day, if you're making good decisions for that, the other part, make sure you seek counsel on, is the most amount forgiven the best goal to structure your business? And when you're doing that, make sure you're reaching to advisors that help business owners make difficult decisions. Those people that are in the business of helping business owners make difficult decisions. if you're an advisor that deals with financial, legal, tax, counseling, etc., and you don't necessarily help business owners make business decisions all the time, add them to your team in talking to those business owners. In the meantime, again, to the Exit Planning Institute board members, help put this on, thank you. To our partners, to those, Steve, Jim, and Caroline, thank you for giving of your time. I know you're busy as hell. Thanks for helping all of us out.
Join us next week again on June 11th, same time, same place. Grab your glass of wine, and we'll see you then.
And we're going to talk about what the heck happened to my value in my business. And if it's gone down, are there things I could do about that? Thank you all.
Bye.
Bye.